You probably have more insurance than you need. And I do not mean that as a criticism. I mean it as a mathematical observation. Most people, when they feel financially anxious by another policy, another layer of coverage, another monthly premium, because that is what security feels like. But here is the paradox. The more insurance you buy chasing security, the less financially secure you can actually become. Today, we are going to run the real numbers on that statement, layer by layer, dollar by dollar, and decade by decade. Before we go any further, let us standardize what we are working with so this conversation is grounded in reality, not theory. Our benchmark profile, a 40-year-old American man, married, 2 kids, earning $95,000 per year. That sits comfortably within the median household income range for married couples in the US. He is in the 22% federal income tax bracket. Inflation is running at approximately 3.4% annually. And for our investment comparisons, we will use the historical S&P 500 nominal return of 10% per year, or 7% real after inflation, as our benchmark. These are not exotic assumptions. These are the numbers that define the actual financial life of the average American man watching this right now. And they are going to do a lot of heavy lifting over the next 16 minutes. One more thing before we dig in. Insurance markets in the US are enormous. Americans spent over $1.4 trillion on insurance premiums in 2023. That is not inherently bad. Risk transfer is a legitimate financial tool. But the size of that number should make you ask, who is benefiting most from the transaction? Now, let us talk about what most people in our benchmark man position actually do. And let me be clear, this is not a story about foolish decisions. Every choice we are about to describe is defensible on its own terms. The logic behind each one is real. Our man has a family depending on his income. He has a 30-year mortgage he does not want to leave behind. He has 2 kids who will need college funding. He drives a car, owns appliances, has a body that can get sick. He is old enough to have watched a friend lose everything in a medical emergency, or a neighbor lose a job and nearly lose the house. He has internalized one core belief: more coverage equals more safety. So he builds what he thinks of as a fortress. He carries a $500,000 term life insurance policy, which any competent financial planner would applaud. He has comprehensive health insurance through his employer. He added a whole life insurance policy a few years back, sold to him as permanent protection with a savings component built right in. He bought an extended warranty package on his car, his refrigerator, his washer and dryer. He enrolled in accidental death and dismemberment coverage through HR at work because it was only a few dollars extra per paycheck. He signed up for mortgage protection insurance after receiving a mailer that made it look like a required product. And last year, when the Suppler Hospital Indemnity Plan showed in his benefits enrollment, he added that too. Every single one of those decisions felt responsible in the moment. That word, felt, is doing a lot of work in this sentence. Because each individual policy is defensible. The problem is never the individual policy. The problem is the portfolio of policies and what it costs in aggregate, and what it prevents him from building over the next 25 years. Here is what most conventional financial advice says: you cannot be over-insured. The insurance industry, obviously, agrees. Even many mainstream personal finance books treat more coverage as uniformly better than less. This is the conventional wisdom, and for someone in a moment of financial anxiety, it is completely understandable to land here. The feeling of protection is real. The math, however, is about to divert sharply from the feeling. Here is where the real calculation begins. Our benchmark man is paying, in total, approximately $847 per month in insurance premiums across all of his policies. That is $10,164 per year, leaving his household in exchange for protection he may never use. Let me break that down precisely, because precision is where the insight lives. His term life policy, $500,000, 20-year level term, issued at age 40, costs approximately $47 per month, or $564 per year. That is an efficient, well-priced product. We will come back to it. His employer health insurance contribution after the employer subsidy, approximately $180 per month, or $2,160 per year. Reasonable and necessary. His whole life insurance policy, face value $250,000, $380 per month, or $4,560 per year. His agent told him that part of each premium builds cash value. Here is the first hidden layer. In the first decade of a typical whole life policy, surrenders, charges, fees, and agent commissions consume the majority of what would otherwise accumulate as cash value. The actual internal rate of return on whole life cash value averages between 1.5% and 0.5% annually over the first 20 years. The S&P 500 over the same horizon has returned 10% nominally. That difference is not a rounding error. Over 20 years, on $380 per month, that gap produces a wealth difference of approximately $162,000, which we will simulate in the next phase. His mortgage protection insurance, $62 per month, $744 per year. Here is what most people do not know. Mortgage protection insurance pays the lender, not your family. If he dies, the bank gets a paid-off balance. His family gets a house but no cash, no flexibility, no runway. His existing term life policy, if correctly sized to cover the mortgage balance, already does this job, and does it better because his family receives a lump sum they can deploy however they need. This is a policy that duplicates coverage he already owns. His extended warranties across appliances and electronics, approximately $80 per month, $456 per year. Consumer Reports has consistently found that appliance repair costs, averaged across a 5-year ownership window, run approximately $127 per appliance, well below the cumulative premiums most extended warranties collect over the same period. For most product categories, manufacturers' defects surface within the factory warranty window. Extended warranties are, in actuarial terms, profitable for the seller because claims are rare. His accidental death and dismemberment coverage, $18 per month, $216 per year. The actuarial reality is direct. The probability of a 40-year-old American male dying from an accident in any given year is approximately 1 in 1,400. His existing term life policy already pays for any cause of death, accidents included. This is a second policy covering a narrow subset of what he already owns. His supplemental hospital indemnity plan, $122 per month, $1,464 per year. These plans pay a fixed daily cash benefit during inpatient hospital stays, typically between $150 and $300 per day. The average hospital stay in the US is 4.5 days. Maximum realistic payout per hospital event, approximately $1,350. He is paying $1,464 annually to ensure a benefit he is unlikely to collect in full more than once in a decade. Add it up. Of his $847 monthly premium, approximately $635. That is $7,620 per year. Is going toward policies that duplicate existing coverage, deliver below market financial returns, or pay out less than their long-run premium cost. This is the figure that changes everything. 635 per month, every month, for 25 years. That number is the engine of the simulation we are about to run. What is driving this behavior is a well-documented cognitive pattern called loss aversion. Loss aversion, first formally described by psychologists Kahneman and Versk, means that the psychological pain of losing something is roughly twice as powerful as the pleasure of gaining the equivalent amount. When our man buys an extended warranty, he is not running a rational actuarial calculation. He is paying a premium to avoid the feeling of loss, and the industry prices that premium accordingly. Let us run the simulation. Two versions of our benchmark men from age 40 to age 65. Call them Man A and Man B. Man A keeps every policy exactly as described. Annual insurance spend €10,001, $64. He continues paying for 25 years, with premiums escalating at 3% per year. A conservative estimate given that health insurance premiums alone have increased an average of 4 to 5% annually over the past decade. Man B makes one surgical change. He keeps his term life policy and his employer health insurance. He cancels everything else. He redirects the free $635 per month into a low-cost S&P 500 index fund, split between a maxed Roth IRA and a taxable brokerage account. The 5-year checkpoint, age 45. Mana paid $55,633 in total insurance premiums over 5 years, accounting for the 3% annual escalation. His whole life policy cash value, accumulating at a 2% internal return on the $380 monthly premium, has grown to approximately $24,000. Or WIVA. Most whole life policies in years 1 through 7 have surrender values that are substantially lower than the gross cash value due to front-loaded agent commissions and policy fees. His realistic accessible cash value is closer to $8,900 at year 5. Net cost, accessible cash value, approximately $46,700 in out-of-pocket premiums. Mamba has invested $635 per month for 5 years at the S&P 500 nominal 10% annual return. His portfolio value, approximately $49,100. His total financial advantage over Man A at the 5-year mark, approximately $22,800. The 10-year checkpoint, age 50. Man A cumulative premium spend has now crossed $117,000 over 10 years. His whole life cash value, at 2% compounding, now stands at approximately $55,000 on the whole life component alone. Batius paid $91,200 in whole life premiums to accumulate it. Net cash flow efficiency on that product, he is down approximately $36,200 compared to simply keeping that money in a savings account. Against the S&P 500 comparison, the shortfall is far larger. Man B investment portfolio, $635 per month at 10% for 10 years, has grown to approximately $129,000. His advantage over Man A at the 10-year mark, approximately $8,500 in combined wealth difference, accounting for premiums not paid and investment growth captured. The 20-year checkpoint, age 60. This is where the numbers become visceral. Man A has paid approximately $272,000 in total premiums over 20 years, factoring in the annual 3% escalation. His whole life cash value at 2% compounding on the $4,560 annual premium has grown to approximately $111,600. He paid $91,200 in whole life premiums to generate that $111,600. That looks like a gain of $20,400. But here is what the illustration does not show you. That same $380 per month invested in the S&P 500 at 10% nominal for 20 years would have grown to approximately $273,800. The difference on the whole life component alone, $162,200. That is the cost of the cash value narrative, measured in dollars left on the table. Man bet a portfolio at a 60, approximately $482,000 from the redirected $635 per month over 20 years at 10% nominal. He carries his term life policy, his employer health insurance, and real liquid wealth. Roth IRA, Ashwan Seng Senk. Man, a 20-year term life policy has expired. If he wants permanent coverage at 65, a $250,000 whole life policy now costs approximately $12,000 to $16,000 per year. His whole life cash value from the original policy, approximately $168,000. After 25 years of 2% compounding on the premium stream, he spent $114,000 in whole life premiums over 25 years to accumulate $168,000. That is a 25-year gain of $54,000 on the cash value component. In a world where the S&P 500 turned the same monthly contribution into approximately $483,000. The gap on that single policy, $315,000. Man beat a redirected portfolio at 65, $635 per month at 10%. Nominal for 25 years produces a terminal value of approximately $817,500. His term life policy has expired, but he holds $817,500 in liquid, flexible, inheritable wealth. That portfolio is its own form of life insurance. If he dies, his family inherits the asset. If he lives, it funds 25 years of retirement income. The total gap between man A and man B at retirement, approximately $149,500 in accumulated wealth. Nearly $650 million. That is the 25-year price of over-insuring. This is not financial advice for your specific situation. Insurance needs vary based on your health history, the number of dependents you carry, your debt structure, your income stability, and a range of factors no video can assess for you. Consult a certified financial advisor before making any changes to your coverage. What this video is providing is the math. The math that most insurance conversations in this country never show you. Now, because intellectual honesty is the only currency this channel trades in, let me tell you exactly when the conventional approach wins. When buying more insurance, including whole life, is the correct financial decision. If you are uninsurable or carry a serious chronic health condition, whole life insurance may be the only form of permanent coverage available to you. In that scenario, the guaranteed death benefit has real, non-negotiable value, and the below-market cash value growth is a reasonable trade-off, not a mistake. If your income exceeds the Roth IRA phase-out thresholds, which for 2024 are $161,000 for single filers and $240,000 for married couples filing jointly, and your tax-advantaged accounts are already fully funded, a properly structured cash value policy can play a supplemental role in a high-income estate plan. The tax-deferred growth has real value at the top of the income bracket. If your income is irregular or volatile, the forced savings discipline of a permanent policy has genuine behavioral value. A 2% return you actually accumulate because the premium is automatic beats a 10% return you never capture because the discretionary cash was spent. The behavioral psychology concept at work here is called present bias, meaning our tendency to overvalue what we can spend today relative to what we could have later. For certain personality profiles and income patterns, the structure of a forced premium product is worth the below-market return. And if you have specific estate planning needs, including business succession agreements, irrevocable life insurance trusts, or providing for a dependent with special needs, permanent life insurance is a legitimate, often irreplaceable tool. The use case is real. The problem is that this use case describes a narrow segment of the population, while the product is marketed to everyone. The higher principle behind everything we covered today is this: insurance is designed to transfer risk you cannot afford to self-insure. The moment you are buying insurance to cover risks you can afford to absorb through an adequate emergency fund, a diversified investment portfolio, or simply accessible cash reserves, you have crossed a line. You have moved from genuine risk transfer into something closer to financial anxiety management. And financial anxiety management is the most expensive product you will ever buy. because it has no expiration date and its premium grows every year. The real measure of financial security is not the number of policies you carry. It is the amount of capital you have working on your behalf. Policies protect capital. They do not create it. The man who carries 3 well-chosen policies and $817,500 in invested assets at retirement is more financially secure than the man who carries 11 policies and $168,000 in whole life cash value. Not because insurance is bad, but because capital is the foundation and no policy replaces it. Review your coverage once a year. Audit for overlap. Run the real numbers on what the premium difference would compound over your time horizon. And then make the decision based on math, not on the feeling that more always means safer. This is not personalized financial advice. Consult a certified financial advisor for your specific situation.